Osakimi here, and this is a new series called Tactical Trading. This is the first series ever that I've started outside of my regular reviews, and this is designed to kind of give some extra trading insights on how to trade, when to trade, things like that. I'm going to cover different topics throughout the series. It's going to be about 10 videos long, and typically about 10 to 15 minutes each per video. And so basically, it's going to be covering specific things, whether it's stop losses or some sort of, maybe it's an indicator, things like that. So the idea is to um, get more of an understanding about what you're trading, how to trade, and just think smarter about it. Honestly, because one of the biggest things that I've seen that really seems to be a detriment is people just trade off of the whim. They trade very sporadically, very emotionally, very degenerate, like things like that. And so I think that's not a good mindset to have overall. I know that tends to be the culture in the crypto world, especially the crypto Twitter world. But amongst all the scams and things like that, I've seen it's typically something you don't really want to be a part of, in my opinion. So whether you like that or not, it doesn't matter, because this tactical trading series is just going to cover basic trading educational ideas. And so that's kind of what that's going to be like. So the first video of this series, I'm going to be talking about stop losses and about entries. I'm going to talk about entries first, actually. But I'm going to put these together to kind of talk about trading positions. So the first three videos, probably maybe the first two, see if I can squeeze it into two, so I can get you more things. But the first 2 to 3 videos are going to be about trading positions, and the first video here is going to be about entries and stop losses. So for entries, why do we enter when we do? How can we enter? Are there different ways to enter? What does it mean for someone to enter a trade versus somebody else? Because there is a difference, and that's the main aspect of entries that I will talk about, because some people enter for different reasons or expect different results when they do so. So that's the first thing. The second thing will be stop losses. What determines a good stop loss? Why do we even have them in the first place? Does it make sense to have a tighter stop loss or a really wide stop loss? Should we even have them? Like, is a stop loss perhaps something else that we should be looking for instead of like a hard price point? And so we'll go into those. So I think it's going to be a very good video. And this isn't like my reviews where I can just ramble and talk. I'm just going to get to the point. We get started. Let's go. All right. So for entries, we'll talk about that first. So trading positions will have 3 things. And I'm going to kind of, I'm not going to use this chart necessarily. So we'll kind of just go above here. And we'll kind of work with just like a plain slate for now, right? So for positions, you typically have long or short positions. Some of these you'll know, right? Long positions are when you want to do spot positions, or when you want to do like leverage long positions, where short is usually just leverage short positions, because you can't really short spot technically. The only way you can do that is just to sell. And that's not necessarily effective in the same way that spot longs are effective. So we'll use a long as an example, and this is your typical generic position where it's just an R&R of 1. If you're unfamiliar with some of these positions, some of these stats on here and the data on this is one reason why I have the Apex Academy, by the way. That wasn't meant to be a plug, actually. I didn't even mean to talk about it here, but I will go into a lot of these things in very, very much detail. And so it's really a comprehensive tool. A lot of people have said that they really got their money's worth from it. It's a great way to, if you barely know anything, you can ask the dumbest questions in the world, not a problem. I was there before. It's a great way to go from basically beginner to intermediate within 12 weeks. And so that's the key of that, is to accelerate your way to being more effective in your trading behavior and style. So anyway, enough of that. I'm going to go into this here. This is your normal one, but this is kind of like your typical what you like to see from a position. You have your so if you're within this and you're not actually, so you haven't sold your position yet, this is kind of a representation of P&L. So if you have a candle, let's say let's say it goes in here and you enter here and it goes up like this, that means you're in profit. If it goes down like this, you are not in profit. You have a negative PL. So those things play into that. So this line right here is what we want to talk about for the entries. This is what you would have as an entry. This would be your stop loss maximum, and this would be your profit maximum, or profit take. There's other names for it. There's no real fixed name anyway, so that's kind of what that is. So now for entries, you can ask yourself a bunch of questions. Like normally it's like why do we enter a trade? Obviously, the answer is we want to make money. That's why we're all here, right? But you got to ask yourself a little bit more of a more deeper question as far as what you expect to happen. And so a lot of people, when they have a candle like this, they expect it just to rip straight up, relatively speaking. And so maybe we can kind of go to, let's just go to a random coin. I don't think I really look at too much. I'll just do flow, I guess. Not the best example here as far as the candles, because we've had a red day today. Get rid of all this. And again, this is just for demonstration. It's not because of anything in particular. Get rid of that brush tool there. So, all right. So, if you were to, let's say you were wanting to take a trade here, and we had a big red day. So this isn't necessarily a long trade to me. This again just demonstration. If you wanted to long this, and so that would be your entry, typically, and we can go through the different types of entries, but this would be kind of what that is. Most people expect it to just immediately launch up here. So this is 12%. They immediately want their 12% like within a few candles at the most. And in my experience, that's just not a good way to trade. People do that, but that's typically going to be that kind of goes into the first type of entry that people like to do. This is an unrealistic goal, for example. You can't expect this 100% of the time because all trades are different, all behaviors are different, all candles are different. But when it comes to the first type of entry, some people will look for a trade to be more advantageous for that accelerated candle. And so what do I mean by that? So the first type of entry would be something like this, right? So let's say for whatever reason, this candle was a short position for somebody that likes this first type of entry. So maybe they put their position like this, right? So they, the candles went straight away from the entry and it kept accelerating down. So this would be an ideal short position for them. So the first type of entry is ones where people expect the price to go immediately away from the entry mark. So, and let me state that again. The first type of entry is those that expect the price to go away from the entry mark because typically their style matches that, or they don't want the price to hang around the entry point long because sometimes that is a sign of weakness. So there's various things like that. The second type of entry is ones that are more just casual. So like they have the expectation that the entry is not necessarily going to go away from the price point or not. And so it could, so for example, you have the brush tool again. It could go like this, or it could go like, it could even do a bunch of, I wouldn't hang around that long necessarily, but it could do a zigzag before it goes down eventually. So there's really two types of traders when it comes to entries, and there's two types of ways to understand entries. Now, most people fall into the first category or the second category. There's really no other option other than just like, I don't know what I'm doing, and that's just what other people do. So you kind of gotta you got to kind of understand that. There are pros and cons to all those. So, for example, one good thing about this is a good pro for the first type of entry, the one that goes away from the entry point, is that you're immediately in profit. And so that's a good sign. And so people will typically tighten their stops like that. And so they have less risk to deal with now. And so they're either guaranteed profit or they have less risk involved. So that's one big pro. That's a major pro. The second pro is typically when they find something that accelerates away from the entry like that, it usually does well. So they typically have a higher performance as well for their wins. Now the biggest cons of that is if price does go down, does go away from it. So like let's say they they went along this and it went say it went to let's go here, say it went down here, they would sell it. And so I view that as a con because in this case it was the correct choice, but in some cases positions can go down before they go up. So that kind of goes into the second thing about stop losses, like our second discussion that we want to talk about stop losses is because why do you even have stop losses in the first place? But we'll get into that into a second. As far as the cons of the first idea, it typically prevents you from getting a potential run on a position. So, one example could be, let's say you want to do a long position and you want to do it here. And so let's say your stop loss was like this, but then you close at this candle or you close at this candle. Because I know some people that will close maybe after two opposing candles. So they would have stopped here for a loss, but guess what? It got into profit and eventually full take profit instead of losing that position. So instead of them gaining 1.4 R, they lost probably 0.3 R. So now they didn't lose that much necessarily because that's the pro of that. They have less overall risk, but then they also have less overall performance in some positions as well. And so this also dictates is like if you plan for this to go above and away from the entry point, as the first option suggests, you think you would have a higher stop loss. But that's again I consider that a con because you don't really get to see the position play out. Now, the way to counteract those cons is to really focus on the type of moves that go away from the entry point. But overall, I do think it can be, it's very useful. I think it's a very high performing one. It's not one that I do, honestly. I do the second one, which we'll discuss. But the first one is really good for like a lot of advanced traders. The key to that is understanding when the prices will most likely go away from your entry point. And so that's that. The second way to view this is to, like I said, let's say you had your long position, and we'll kind of just change this to where it looks a little more clean, that you expect price to go anywhere within this zone. And the reason for that is because you don't really know what price is going to do. You never really know. You can always be wrong. You can always be right. And so the more you become right, the more you become arrogant, the more you become wrong, the more you get upset and you doubt and things like that. And neither one of those are really healthy long term. But overall, in my opinion, this is one reason why stop losses are so important, because this stop area is the wiggle room that you need to assess in order to get the right profit taking. So a full position would be like, this is your area of profitability as a P&L chart and unrealized profit gains, and this is unrealized profit losses. Now, if you set your full risk at the bottom of this, then you know that you're not doing your full risk until you get to that point. So that's how you offset the risk from that. But overall, this is the one that I do the most because let's say I feel like this is going to go up, but I know that it also could go down. Well, where do I want it to go down? And so that's kind of where stop losses come into play, and we'll get into that very shortly. For me, it would probably be here at the marker here, just past, like maybe right here, and then maybe a little farther down. That way it presents an invalidation point, and we'll get to that in a second. But as far as this goes, this presents me with a good amount of wiggle room because I can expect this to go down because it already has been going down, and prices can go in the opposite, back and forth. There's numerous reasons why a position will go up and down, and no candle is guaranteed. And so that's one reason I don't necessarily subscribe to the first option, is because you are expecting things to go a certain way, where this is more understanding how markets behave. And so the first option is you are willing something, you are trying to make something happen that you have no guarantee of happening, where this is more like, I understand all the options and I'm prepared for all of them. So if that makes sense. So this one's more contingency based, where the other one is more, led by what you want out of the market, which can be a good thing if you know what to expect. But sometimes not really, because that also opens you up for stop hunts and things like that. The biggest pros of this is that this presents a good way to have risk management, because you understand, like, I'm not going to sell this position until I get below here. I'm not necessarily going to sell this position until I go here. Now you can, and oftentimes I do, and I assess that afterwards. But this pro gives you a very good assessment of risk management, gives you a good understanding of how trades work. Another one is you learn to be patient. You learn to understand that some candles are meant to be there, like, because you let's say you get 3 bullish candles and then you get a bearish one. Like, you don't need to freak out about that, because it's very common. I mean, look at this. Like, you got 4 bullish candles right here before you continue downward. Now, if you told me that you were going to stop your short from here, you would have lost out onto new lows. And maybe that's not what you wanted. That's okay. It depends on the trade. But the thing is like, when you subscribe to the first one, you are more susceptible to paranoia and emotions from opposing from anything that opposes, like, your strict goal of what you want. You're required to be more strict, but this requires you to be more flexible. So that's the thing. A con out of this, though, is that you do need to be patient as well, and oftentimes you may not get the results that you want, and so that's something you got to be prepared for. Sometimes I've seen it to where I've had positions go up very healthily up to here and then go down, and so you need to decide up here, should you take profits. And over time, in my experience, I have, mainly because it's close enough, right? So you need to understand it. And also, it could go, I've seen positions go down here and then go back up. So it's a little more unpredictable as far as what you expect, but it also gives you contingencies to deal with that. And so it requires you to be a little more patient, which a lot of traders don't have. So it just depends. And neither one of these options are wrong, by the way. You can do the first one, you can do the second one. There are some instances. So I mainly subscribe to this second one here that's on the screen, but sometimes I also do the first one. It depends if it's like a breakout trade. I expect breakout trades to break out, and then if they don't, I quickly sell them. Also known as a Darvish trade. If you familiar with me talking in the academy, I talk about Darvish trades a lot. So that's an option where I focus on the first viewpoint. But on a typical trade, I usually do the second point. The second one also kind of prevents you from, like, stop hunts, things like that too, because you're not as susceptible to being targeted as well. So those are a few things with that. And so also with this, you also have 2 types of entry points as far as behavior, and some of you may have noticed this. There's there's margin trades and there's limit trades. And so a margin is when you get the exact point. So like, or no, I'm sorry, limits are when you get the exact point. So limit orders, if you want to buy at 72.2 cents, you are going to buy at 72.2 cents. And so that's the option. So now if the price goes away from it, if it goes up to like 80 cents, you are not going to get entry. And so a lot of people that do the first option tend to do limit orders to kind of compensate for that. Again, another con of that is limit orders are put on the market books, so you can get susceptible to stop hunts. The second option is market orders, where you get the closest price point like that you could get to enter. So limit orders are, I want the exact price. I don't care if I get in or not. I just want the price. Market order is, I just want to get in. I don't care about the price. And so you might be able to see limit orders are more likely to be the first option, whereas or limit orders are designed to be the first option. Market orders are designed to be the second option. And so I typically do market orders as well because it's a little more flexible. It's not in the order books. I will set an alert instead on my TradingView account. And I get a message on my phone or my computer or what have you that tells me when I need to exit or enter a position. And so that's typically how I handle that. So in short, those are the two types of entry points. Both have their use cases. I think both have their pros and cons. And I think both can be used simultaneously in different ways, but that also might give you some ideas, because maybe you thought maybe you were trading the first maybe you were trading with the first method, but you were behaving it like the second, or vice versa. I know a lot of people, it's very instinctively also to trade off the first one, where you expect price to go up immediately. It doesn't happen, so you sell. You sell at a loss or you sell at a small gain, and it goes the way that you wanted it to go, and you didn't hold on. Well, that's because you're actually a different type of trader. You are the second version of this in this video for more flexible trade entry versus a strict trade entry. And so you may just be trading differently than how you're behaving, and so that could be a reason why you're not gaining as much money. And so that's an option to consider when you're trading. So anyway, that's all that. I'm going to go briefly into stop losses. It won't take too much time, but then that'll be the end of the video. All right, so the second thing is stop losses. And mainly the big caveats with stop losses is, like, why do we have them? What's a proper stop loss? How tight does it need to be? Things like that. And so let's go ahead and bring up the long position again, and we'll go ahead and put it at the entry point. So this is our long P&L, and this is our stop loss area. So the whole reason for stop losses, it's designed to be wiggle room to not, or it's designed to have us some wiggle room to prevent us from having a full loss. And so that doesn't make sense to most people unless you have risk management. And that's one of the reasons I bring this up, is because a lot of people, especially in the first category, will have the candles, and it goes up like this, and then it goes down, and then they sell. So like it could go like this, whatever, and as soon as it goes down, they sell. As soon as it goes in the opposite direction, they sell. And so again, that's okay if that's what you're looking for, but that doesn't really serve well when it comes to stop losses, because the whole stop loss idea is that you allow price to do something differently that's opposed to your trading position until it reaches that full stop loss position. So let me see if I can get rid of this brush tool, and we're gonna go ahead and reload this here. So if you have this, that means your entry is 72.2 and your stop loss is 57.3. The whole concept of this is you are not expecting the price to get down here at the very bottom, 57.3. But the idea of this darker gray area is that you do expect price to be a little bit in this area. Otherwise, I mean, if you don't, why don't you just have your stop loss like this? And obviously that's unrealistic, right? First of all, you're going to get stopped out immediately. But second of all, we know by nature that this is more accurate. This is what it's supposed to be. The problem is we don't typically exercise the risk management to do it. So that's the reason why. So how can we create a good stop loss behavior? And so the general consensus and textbook idea is we put stop losses in an area that doesn't make sense for price to go. It's put in an area where price should not go unless something different happens that changes the narrative of your position or the chart. So for example, right here, if we were to long this, which I would not long this for several reasons, but let's just say I was forced to long this position, where would my stop loss be? Well, I do know that we have a series of lower lows, so I do expect this to go down a little bit lower. So I need to have a wider stop loss, which I do. If I was not expecting it to go lower, I would have a tighter stop loss. But I am expecting it to go lower. We do have kind of a engulfing pattern here. And so if you're not familiar with engulfing patterns, you can check my recent observations video. I also discussed that in Academy, but I can discuss as well. It's kind of when a price goes beyond, like this is an order block and the price point pushes through that order block. So typically it would retest here or down below, which it currently recently has. So I'm expecting this area to be a very healthy bounce area at some point. So, and we also have a low position right here. So I think that this, I don't necessarily think this, by the way. If I had to blind trade this, I'm not going to trade this position. I'm not really interested in flow right now anyway. But if I had to trade this, I would say this order block and this whole, area should hold. If it doesn't, I would expect this low to hold. And so I want to have my stop loss. I don't want to have my stop loss here because that's too tight, given that it could go down to the low. I don't want to put it at the low because it could get retested. It's very common to retest and then go back up. So that would get me out of the position at the worst case scenario. I would put it a little bit lower, somewhere around there. And so we can try to look more cleanly at the charts and see. Okay, so that's all the history that we have. So this here is actually the low of the entire chart. So this makes sense to me. Now you could add more if you want, if you're more comfortable with that, or if you want to be more risky, you can tighten it up. 15% roughly sounds good to me. I would probably even put it a little bit lower to maybe get out the people that are focused on the math of that. So this would be kind of what I want to do. Ideally, if I wanted to long this for real, I would probably wait for it to come down here and then do something like this. And so that would give me a much higher R to R, 2.8 versus 5.3. This doesn't really look healthy to me. It's a new low of this region, so I think it would continue down. But as far as the stop loss thing, education-wise, is concerned, this is how I would set up the stop loss. So this gives me enough wiggle room to compensate for this retest and also the low retest. And so if this breaks, then I know it's worth getting out anyway, because now we're in new low territory and it's not worth holding on to at that point. I'd rather wait for a reclaim or et cetera, et cetera. So that's how I view that. Now, going back to the entries, if you are expecting this to go up right away, then you should have a tighter entry. It makes more sense to have a tighter entry. If that's the case, I would probably have it at the bottom, or maybe at the bottom of this region here, where this retested. So I think right here roughly makes sense, about 4.4, just the bottom of this region here. So that would be what I'm looking at. The problem with me is this doesn't make sense to me necessarily. One, because you need to, for when it comes to the first type of trade, you can only trade at specific instances. You can't just do that all the time. You need to know what you're looking for. This is not something, in my opinion, that prescribes that type stop loss. This is a much wider environment to me. But even if that wasn't the case, you're putting your full realization here. So let's say you're risking $1,000, right? So with the anticipation to get a 10R, so you're risking 1,000 to gain 10,000. Are you really going to risk 1,000 with such a tight stop loss? Or you could do something like this at the 15 marker, and you're risking 1,000 here, but you're only going to get 3,000. So that's another thing. Another option with this is to also increase the risk here times 3, to risk 3,000 to gain the 10,000. But that's also riskier as well. So that bears in mind when you have the quick flip. You are also typically generating higher R&R positions as well. Maybe it depends how you're viewing that. But this is the tight stop loss for the first version. This is the second one, the more wider stop. And so the wider stop is going to be more flexible to a trading plan. And again, neither one of these are right or wrong necessarily. It's based off of your behavior. And I say all this to say you might be behaving as one type of trader with entries and stop losses, but doing the other one. And so I feel like this was a good I feel like I wanted to share this video. I've seen a lot of people doing this lately as well, that I don't think they really know what they're doing. So that's maybe and maybe not. It's not really the point. But the point is, entries. You view entries differently depending on who you are, and you also have different results and different expectations depending on how those entries are made. And then they also have different stop losses as well. So that's the video. I thank you for watching. If you are not subscribed, please subscribe. If not, I thank you for listening for so long. And I hope you have a good day. Thank you.